Stop everything right now if you are a senior, retiree, or green card holder with any money in a foreign bank account. The IRS is cracking down on foreign account reporting, and these tax mistakes can destroy your naturalization application and your immigration status. Millions of people are breaking federal law right now without even knowing it. You are watching Citizenship and Visa, and this video could save your American future. Before we dive into the details, I need to give you one very important disclaimer. Nothing in this video is tax advice, and nothing in this video is legal advice. I am not a CPA, I am not an enrolled agent, and I am not an immigration attorney. What I am doing here is explaining general concepts based on publicly available information from the IRS and USCIS, so that you can understand what questions to ask and what red flags to look out for in your own situation. Your specific circumstances may be very different from the examples I discuss, and for personal advice, especially if you have foreign accounts, foreign pensions, or complex tax questions, you absolutely should speak with a qualified tax professional and, if needed, an immigration lawyer who can look at your complete picture. With that important disclaimer out of the way, let me explain what is really going on and why this matters so much for seniors, retirees, green card holders, and naturalized citizens across America right now. The IRS has been putting significantly stronger emphasis on compliance in several key areas that matter enormously for seniors and retirees, particularly those who have foreign pensions from countries where they previously lived and worked, those who have overseas bank accounts or investment accounts that they may have maintained for decades, and those who have ongoing financial ties to another country where they spent many years of their lives before coming to America. This is not some brand new tax that was created overnight to punish immigrants and seniors, and it is not a secret rule that the government suddenly invented to catch people off guard. These reporting requirements have existed for years, but what has changed is that the IRS is now enforcing these existing rules far more aggressively than ever before. They are using better technology and international data sharing agreements to detect when people miss certain filings. And they are putting dramatically more focus on international tax reporting, especially for people who are considered U.S. tax residents, which includes U.S. citizens and most green card holders, regardless of where they were born. Now, here's why this really matters, if you care about immigration. And if you are watching a channel called Citizenship and Visa, you probably care a great deal about your immigration status. The IRS does not approve or deny immigration cases. That is not their job. USCIS and the IRS are completely separate government agencies with different missions and different databases. But here is what catches so many people off guard. Indirectly, tax compliance absolutely can show up in immigration proceedings and affect your case in at least 3 critically important ways. The first way is when you apply for naturalization to become a U.S. citizen. The second way is when you sponsor family members for green cards or other immigration benefits. And the third way is when immigration officers evaluate your good moral character or examine whether you have truly maintained continuous residence in the United States. If you are a senior or retiree with foreign assets, foreign bank accounts, or foreign income streams, getting this wrong can create serious IRS penalties and financial headaches on one side, and on the other side, it can create extra questions, delays, requests for evidence, or outright scrutiny in immigration processes that you thought would be straightforward. Let me start with the absolute basics of tax residency, because this is where everything begins and where so many people get confused. If you are a United States citizen, or if you are a lawful permanent resident, which means you hold a green card, the United States government generally treats you as a U.S. tax resident regardless of where you physically live and regardless of where your money happens to be sitting. There are some exceptions and some special cases that apply to certain situations, but the default rule that applies to most people is very simple and very broad. U.S. persons, which includes citizens and most green card holders, are taxed on their worldwide income. That one word, worldwide, is what trips up so many seniors and retirees who came to America from other countries. Worldwide income means exactly what it sounds like. It includes your Social Security benefits, your U.S. pensions, your IRA distributions, your 401k withdrawals, your annuities and other retirement income, your investment income from interest and dividends and capital gains. But it also includes foreign pensions that you earned in another country, foreign rental income from property you still own overseas, foreign investment income from accounts you have maintained abroad, and essentially any other income that flows to you from anywhere on the planet. All of this can be relevant for U.S. tax reporting purposes, even if some of the tax burden is reduced or offset by foreign tax credits or international tax treaties between the United States and other countries. For many retired people, this is exactly the moment when their U.S. tax situation gets more complicated, precisely when they feel like it should be getting simpler. Instead of one paycheck from one employer with taxes automatically withheld, suddenly you have multiple income streams coming from different sources. Instead of everything being domestic and straightforward, you have a mix of U.S. and foreign sources of money flowing in. You may have gone through changes in filing status because of marriage, widowhood, or divorce. You might be spending part of the year back in your home country, visiting family or taking care of property while still maintaining your U.S. immigration status. And now, layer on top of all that complexity the foreign account reporting rules that I am about to explain, and you can see exactly how so many seniors and retirees get caught completely off guard by requirements they never knew existed. The two big foreign reporting tools that you absolutely need to understand are the FBAR, which stands for Foreign Bank Account Report and is officially known as FinCEN Form 114, and Form 8938, which is called the Statement of Specified Foreign Financial Assets and gets filed along with your regular tax return. These two forms sound similar, and they cover some overlapping territory, but they are completely separate requirements with different filing thresholds, different filing methods, different deadlines, and different penalty structures. Understanding the difference between them is essential if you have any foreign financial connections at all. The FBAR is not filed with your regular tax return, like most people assume. Instead, it is filed electronically, directly with the U.S. Treasury through a system called FinCEN, which is the Financial Crimes Enforcement Network. Form 8938, on the other hand, is attached to your regular Form 1040 income tax return and goes to the IRS along with everything else when you file your taxes, assuming you meet certain asset thresholds that require you to include it. Let me break down the FBAR first, because this is the one that catches the most people by surprise. The FBAR filing requirement applies to you if you are a U.S. person, which normally includes U.S. citizens and most green card holders, and if at any point during the calendar year the combined total value of all your foreign financial accounts exceeded $10,000 in U.S. currency. That $10,000 threshold is critically important to understand correctly because many people misunderstand how it works. The $10,000 is not per account. It is the total across all of your foreign accounts combined, and it is based on the highest balances at any time during the year, not the average balance, and not the ending balance on December 31st. So, if you have 3 foreign accounts, and at some point during the year one had $5,000, another had $3,000, and the third had $4,000, you have exceeded the threshold, even though no single account ever held $10,000, because the combined total of $12,000 at that moment triggered the requirement. Foreign accounts that can count toward this threshold include savings accounts at foreign banks, checking accounts at foreign banks, foreign brokerage or investment accounts, certain foreign retirement accounts depending on how they are legally structured, joint accounts with family members where your name appears on the account, even if you do not consider the money to be yours, and accounts where you have signature authority or control, even if the funds technically belong to someone else, like a business or a relative. Many retirees think to themselves that they do not need to worry because it is just an old account back in their home country. The money comes and goes. They do not really use it anymore. And besides, it is not that much money anyway. But if those account balances combined ever exceed $10,000 at any point during the year, an FBAR filing is likely required. And the penalties for failing to file FBARs when required can be absolutely devastating, even for non-willful violations where the person simply did not know about the requirement, and astronomically worse for willful failures, where the government believes you knew about the rules and intentionally ignored them. Now, let me explain Form 8938, which is the other major foreign reporting requirement and is separate from the FBAR, even though they cover similar ground. Form 8938 is attached to your IRS Form 1040 and applies when the total value of your specified foreign financial assets exceeds certain thresholds that depend on your filing status and whether you live inside or outside the United States. For people living inside the United States, which includes most green card holders and naturalized citizens, single filers generally need to file Form 8938 if the total value of their specified foreign financial assets is more than $50,000 at the end of the year, or more than $75,000 at any point during the year. For married couples filing jointly, the thresholds are typically around $100,000 at the end of the year, or $150,000 at any time during the year. If you are considered to be living abroad for tax purposes, those threshold numbers are significantly higher. The exact amounts can change and depend on various factors, so you always want to check the current IRS instructions or ask a qualified tax advisor about your specific situation. Specified foreign financial assets for Form 8938 purposes can include foreign bank accounts and brokerage accounts just like the FBAR, but can also include certain foreign mutual funds, foreign pensions, and some retirement plans depending on their structure, foreign life insurance policies that have cash value, and ownership interests in foreign partnerships or foreign corporations. The definition is quite broad and captures many types of foreign financial interests that people do not think of as bank accounts. Here is something that confuses many people. It is entirely possible, and actually quite common, to need to file both the FBAR and Form 8938 in the same year if your situation meets both sets of filing requirements. They are not either/or. They are separate obligations that can apply simultaneously, and filing one does not excuse you from filing the other. So why is the IRS putting so much more emphasis on these foreign reporting requirements right now compared to previous years? There are several converging factors driving this increased enforcement focus. First, the IRS now has dramatically better technology and access to international data through agreements with foreign governments and foreign financial institutions. Under programs like FATCA, which is the Foreign Account Tax Compliance Act, financial institutions around the world are now reporting information about accounts held by U.S. persons directly to the U.S. government. This makes it much easier for the IRS to identify taxpayers who have foreign accounts but have not been filing the required reports. Second, there is ongoing political and institutional pressure within the government to crack down on offshore tax evasion. Going after people with hidden foreign money scores political points and is consistently a funding priority for the IRS, regardless of which party controls the White House or Congress. Third, the demographics of the U.S. taxpayer population have shifted dramatically over the past few decades. More and more U.S. taxpayers, including immigrants and retirees, have legitimate assets, pensions, or savings outside the country because of their life histories, and the existing reporting rules were designed to capture this kind of international financial activity. For many seniors and immigrants, missed filings are genuinely about not knowing rather than intentionally hiding anything. These are people who would have filed the forms if they had understood they were required, but they simply never learned about these obscure requirements that get very little publicity. However, from the IRS perspective, the law is the law, and ignorance is not a defense. You either filed the required forms or you did not, and there are consequences for not filing regardless of why you failed to do so. Now let me connect all of this back to immigration, because that is really why you are watching Citizenship and Visa and not a general tax channel. The IRS does not control immigration decisions, and they do not have any direct authority over whether you get a green card, whether you become a citizen, or whether you can sponsor your family members. But immigration agencies, especially USCIS, can and do consider tax compliance in certain important contexts, and this is where the worlds of taxes and immigration overlap in ways that can catch people by surprise. Naturalization is one of the main areas where this overlap becomes critically important. When you apply for U.S. citizenship using Form N-400, USCIS reviews your entire history to evaluate whether you meet the requirement of good moral character. Part of that good moral character evaluation can involve looking at whether you filed all required U.S. tax returns during the statutory period, whether you have large unpaid tax debts, and what steps you have taken to address them, and whether there are any signs of intentional non-compliance or dishonesty in your dealings with the government. If you are missing tax returns for years when you should have filed, or if you have unresolved tax problems that show up when USCIS pulls your records, an immigration officer may request additional information and documentation, may ask you to fix those issues, and demonstrate compliance before they will approve your naturalization application, or in some cases, may delay or deny your application entirely until you can demonstrate good faith efforts to get into compliance with all applicable requirements. Family sponsorship is another important area where taxes directly intersect with immigration. When you sponsor a family member for a green card, you generally have to submit tax returns or official IRS transcripts as part of the affidavit of support process. These documents show whether you have sufficient income to support your sponsored relative and prevent them from becoming a public charge. If those tax documents show irregularities, like years where you did not file when it appears you should have, or income figures that do not align with what you claim in your petition, your case may receive extra scrutiny or generate requests for additional evidence that can delay the process significantly. Residence and abandonment questions can also intersect with tax filings in ways that many green card holders do not anticipate. If you are a lawful permanent resident who spends significant amounts of time outside the United States, how you file your taxes can become part of the overall picture when immigration authorities evaluate whether you have truly maintained your residence in the United States. For example, if you file taxes as a non-resident or claim tax treaty benefits that suggest you are not really a U.S. resident, but then you tell USCIS that you have continuously maintained your residence in America, that inconsistency can create serious problems. Let me be very clear about something important here, so that nobody panics unnecessarily after watching this video. A single missed FBAR, or a single overlooked Form 8938, on its own, does not automatically destroy an immigration case. These are not automatic disqualifiers that will get you deported or prevent you from ever becoming a citizen. But a pattern of unaddressed tax problems over multiple years, or serious inconsistencies between what you tell immigration authorities and what you tell the IRS, or evidence of intentional non-compliance with known legal requirements. These things can absolutely create problems at exactly the worst possible time when you are trying to naturalize, sponsor family, or defend your resident status. So what should you do right now if you are a senior, a retiree, a green card holder, or a naturalized citizen with potential foreign reporting issues? Let me give you a practical step-by-step approach that you can start implementing immediately. The first step is to gather information systematically rather than relying on memory or assumptions. Get your foreign bank account statements and savings account statements for the past several years. Get your foreign investment account summaries and brokerage statements. Get any statements or official descriptions of foreign pensions and retirement plans that you receive or are entitled to receive. Pull out your U.S. tax returns for the last several years and review what you actually reported. Write down what types of foreign accounts you currently have, what countries they are located in, and roughly what the highest balances were during each year. The second step is to check whether the thresholds for FBAR or Form 8938 might apply to your situation. If you have any foreign accounts at all, especially if their combined value is at or above $10,000 at any point during any year, do not simply assume you are exempt or that the rules do not apply to you. Actually check the requirements or speak with a professional who can evaluate your situation properly. If you have larger foreign holdings like pensions, investment accounts, or real estate interests held through financial accounts, it becomes even more essential to determine whether Form 8938 reporting applies to you. The third step is to seriously consider getting professional help rather than trying to figure everything out yourself through internet research and guesswork. International tax rules are genuinely complicated and not beginner-friendly, and the consequences of getting them wrong are severe. If you have multiple foreign accounts, if you have foreign pensions or retirement plans, if you split your time between countries, or if you have any complexity at all in your foreign financial situation, you are exactly the kind of person who can benefit enormously from working with a tax professional who has specific experience with FBAR filings, Form 8938 reporting, and foreign income and pension issues. Find someone qualified, explain your complete situation honestly without hiding anything, and ask them to help you figure out what needs to be filed and whether any past years need correction. The fourth step is to educate yourself enough about these forms to recognize them, understand their basic purpose, and not be intimidated or scared off by their official-sounding names. Know that the FBAR is filed electronically, typically by April 15th, with an automatic extension to October 15th if needed. It goes to the Treasury Department through the FinCEN system, not attached to your Form 1040. Know that Form 8938 is attached to your Form 1040 tax return and asks about specified foreign financial assets above certain thresholds. Form 8938 is not a tax bill in itself. It is an information filing that supports your return and helps the IRS understand your complete financial picture. Different forms, different thresholds, different agencies, different penalties, but both are essential parts of the overall compliance picture for people with foreign financial connections. The fifth step is to keep organized records once you start filing correctly. Save copies of all your filed tax returns. Save confirmation receipts from your FBAR submissions through the FinCEN system. Save copies of Form 8938 that you attach to your returns. Save any correspondence you receive from the IRS about foreign accounts or international reporting issues. If you are a green card holder planning to naturalize in the future, these organized records become especially valuable when an immigration officer asks about your tax history and you need to demonstrate that you have been fully compliant. Your goal as a senior, as a retiree, as an immigrant with foreign ties and foreign financial connections, is to stay organized and know where your money is and what reporting requirements apply to you. Your goal is to be honest about your situation with both the tax authorities and the immigration authorities, never telling one agency something that contradicts what you told the other. Your goal is to get the right professional help when you need it, rather than trying to navigate complex international tax rules on your own. And your goal is to fix mistakes sooner rather than later, because problems that are addressed proactively are almost always easier to resolve than problems that are discovered by the government. You are not alone in feeling overwhelmed by all of this. The systems are genuinely complex, and the rules are not intuitive or easy to understand. But step by step, with accurate information and proper support, you can protect your finances, protect your immigration status, and protect your peace of mind. Thank you for watching Citizenship and Visa, and I will see you in the next video.